The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady, and this is our hour to talk about taxes. Not that everybody isn't talking about taxes. I hope you guys had a wonderful Thanksgiving with your family and your friends, and I hope that you aren't, you're probably stuffed with turkey and turkey soup and leftover turkeys and turkey sandwiches and hot turkey sandwiches. Anyway, I'm joined in studio with Christopher Fabian. Hey, Chris.
Hello, Esther. I was going to say they're probably still tired of listening to Christmas music that started 2 weeks ago.
I know. But, we got the retail season coming up.
Very
and Tiffany
important.
Fabian.
Hello, Esther.
But you love Christmas music, don't you, Tiff?
I do. But I got to tell you, after Christmas comes tax season. And so I guess I like Christmas so much is because I try to soak up my family, because pretty soon I will be not soaking them up. I'll be sitting in the office.
That's true. I always say my favorite day of the year is the last day of tax season, and my least favorite day of the year is the next day after tax season, because then I know I got it. It's coming again, you know. So
it's true.
But anyway, but I'm very blessed because I love my clients. I think it's just the number of hours, to work 8 o'clock in the morning till 10 o'clock at night. That's,
and then
and then that catheter hanging by the chair.
And then don't forget, pretty soon all of our 29 area offices open for business. So we'll look forward to seeing you and helping you with all your tax need and planning.
And if you're wondering about how the tax law changes are going to affect your tax return, you can call us, and you don't have to be our client. Just tell us your if you're married or single and what your income was last year, and we will tell you how the changes affect your tax return coming up. All right? So that you can plan, because we certainly will be doing a lot of planning. And there are things that you can do, right?
Yep.
Yeah.
All right,
Always.
and this week is a non-phone call week. Love to hear from you by phone. You can email us anytime at egtax.com and go on our little icon there and ask a tax question. But right now, this is email day.
But if you have questions during the week, you can reach us at our office.
Oh, yeah, 632-7886.
We're always there. We're a click away by email. So
Yes, we're a
Go to
click away.
our website.
All right, let's go to the emails.
I've got Melissa from Grand Island. Esther, hi, this is Melissa. I'm currently paying for health insurance through my employer, and I only make $37,000 a year. I'm single. I can't afford to pay this health insurance. Will I be penalized on my tax return for dropping it? And how much would I have to pay for not having health insurance for 17?
So I wish Melissa were here, because if she were paying more than $3,000, then she has the right to drop her employer's health insurance and go to the marketplace and buy it herself, the essential plan.
Right, which is like $20
What people
a
don't
month.
realize is just because your employer has an expensive plan, that may not fit, your budget. And there are options. And if it's just kind of use 9% as a figure.
Right.
If you are paying more than 9% of your wages for health insurance, then you have the right to not use your employer plan and go to the marketplace. And as a matter of fact, doesn't the employer get penalized for that if you drop them?
Oh, no, only if it's under the 8. No, she won't be entitled to subsidy if she's under the 9%. I don't think the employer does get penalized.
I thought they did, but,
We
it's
can
one of those
double-check
things
with Tim.
way in the back of my mind, floating around. I in my mind says I think he gets penalized, but
I think also that Melissa should call our office, because we have
Our own
two
healthcare
navigators, several healthcare navigators who work for us, and then we can also run the numbers.
And we don't charge you to navigate your healthcare situation. The important thing is,
truth is-
if your healthcare is killing you,
Right.
then give us a call, because we are there to help you. We have people on staff that do not charge to help you. They are your advocates. And the important thing is that, like we were talking last week, we were talking about if you have a Cadillac or a Lexus or a Rolls Royce in your health insurance driveway, and you're not driving it because you don't really have that need, then you should change to the kind of vehicle you need.
That's right.
That's less expensive, and that's part of what we help people do.
And the truth is, I think, Chris, correct me if I'm wrong, but from what I see, I'd like to confirm by talking to her that she wouldn't pay any penalty. I think we could do on the 89.
Maybe, possibly. You'd
Right.
have to look. See, this year, with the new subsidies going in from the federal government, the second lowest tier silver plan got reduced. So she may still be subject to a penalty. I know what you're thinking, saying it's unaffordable.
Right.
But we got to look at the numbers that New York State comes back with the second lowest silver plan. And what was I?
It would be if it would be
Her
done-
penalty, if she were to get hit with a penalty, her penalty would be $925 on her tax return. So, I mean, I've seen where some people think my insurance is so expensive through work, but do they really know how much their insurance really costs? You know, if they went out
look
on
at that double D on the bottom of the W-2, and it isn't for your underwear size either. It's how much that your health insurance is, right?
Yep. Yeah, well, it's how much the total plan
Right,
costs.
how much
for
your
that.
health insurance is.
Right. Not how much you. So look at that whole picture. Maybe you can go on a cheaper plan with your employer also. So there's different options for you, Melissa. Don't just turn around and give up because
There's lots of options.
there's a lot of
Well,
options.
and that's the whole thing. In the Bible it says, "My people perish for lack of knowledge." And that's really that's from 6,000 years ago. But it's the truth. If you don't know, it is a terrible thing because you can absolutely get beat up, and it kind of frustrates me when I listen to all these commercials on TV about the Humana Health, and I'm just saying Humana. I'm not picking on Humana, but the big book and whatever. But people don't know what that means, and that's one of the wonderful things about sitting with a human being. And we're not going to charge you, so talk to somebody, even if it's not us, about your health insurance to make sure that there isn't something else that's available to you.
Yeah.
And there's a lot of exceptions to the penalty. If you're going to charge yourself the penalty, please get a second opinion.
If you're going to charge yourself the penalty?
the IRS.
If the IRS.
Okay.
Yes.
All right. What else we got here?
Al writes in, I want to help pay for my grandson's college. I plan on taking out $15,000 from my 401k. How much money should I have withheld? At my job, I make about $75,000 and plan on working another 10 years until I'm 65. My wife died 4 years ago, and I just want to bless my family.
So he's
I
about
mean, I think
55.
that's, it's a lovely thing to bless your family.
Right.
But if you take the money out before you're 59 and a half, and he clearly is, it's going to be taxable plus a penalty on the federal and the state. And
Does it say it's from
I
an
just
IRA or a
think that
pension?
401k.
he needs to look at another way to help fund his grandson's college, right?
Yep.
Yep.
Which would be like what? Like 529
I was going to say a 529. He's single, unfortunately, so he could put $5,000 away a year, and that would be a subtraction from New York. So that would save a little bit of money on New York, not the federal. Maybe a home equity loan, and then once he reaches 59 and a half, take the money out and pay off the home equity if he wants to.
That's true. And so if he's thinking the $15,000 is going to go to his grandson's college, and that's the number he's trying to get at, maybe he'd be better off doing it a different way. Maybe a combination of 529, a home equity credit line, things of that nature.
0%
until he's
interest
59 and a
credit
half.
card.
So,
Yep.
but more than anything, give us a call because I think we should talk. This is too important to just do over a quick email.
Yeah,
right?
because he's looking 25% and.
Okay, I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break, and we'll be back on the other side with your questions. Hi, I'm Esther Golias, the tax lady from EG Tax. Today, we are not taking phone calls. We are just chewing up your emails. I got Tiffany Fabian and Christopher Fabian in the studio with me. And so what's the next?
And then, well, I also wanted to
yeah.
say about Al that we were talking about a minute ago, and then not to mention he wouldn't get to claim the college credit on his return. His grandson would get to claim the college credit.
His son.
His son.
His son.
Daughter.
Sorry.
Right, not his grandson.
Yep. So just another ding. Just make sure you give us a call.
And it's so interesting. These are all like dominoes. If
Yeah.
this domino falls, it hits that one. Oops, that makes that fall. That hits the other. You want to make sure that what you're doing is the best for you.
Yep.
So give EG Tax a call. There's no charge. We'll be very happy to help you.
Well-
and we have real people answering the phones.
We do.
All right, let's go back to the phones.
Talking about doing what's best for you. We've got Justin. My daughter says, tax lady, my daughter is starting college this fall. She has a full scholarship, plus she gets another $10,000. So who claims the education credit? Does she claim herself? She turned 21, and she's a junior.
Well, wait.
Well, who gets that
I was going to
education?
say, well,
There
maybe
isn't
Justin
one.
and Al can talk and they can hook their grandchildren up together.
I mean, if you can only get the education credit if a couple things happen. First of all, it has to be the first 4 years of higher education. Secondly, there has to be a cost.
That's
Yep.
right.
So if she really is on a full scholarship that's paying for her books, classroom supplies, and education, then there's no cost to put on the education credit. And the third thing, again, it has to be cost. So if there's a scholarship involved, that it doesn't qualify. Now, this sweet, lovely girl has another problem. What's her other problem?
The extra scholarship of $10,000.
Well, what could that be, Chris?
Well, that's not earned income. That counts as income on her tax return. And depending on her situation, if she has no other income, you're looking at kiddie tax.
right.
So that means that $10,000, which you think, oh, on a young kid, it's not going to cost a lot. That's good. But actually, it would cost them what mom and dad's tax rate is.
Their tax rate, right.
And
So if
so-
mom and dad are at 25%, it's going to cost her
25.
25%. There's a couple adjustments here or there, but it'll cost her 25%.
So that answers one of those questions where it
For
says
those
who
of you
should
that
claim
have
her.
children in that wonderful position where their education is covered and they're getting excess scholarship, maybe what you want to do is see if you can't have the college reallocate some of that money to maybe for next year. Maybe this is a 1-year scholarship, and next year she doesn't get anything, and see if they can't take that extra $10,000
Divide
and
it
move
over
it over
4.
to next year. So it pays for scholarship next year, so she doesn't have to pay income taxes on the excess scholarship. But excess scholarship is taxable on line 7.
Yikes.
All right?
Yep.
All right, what we got?
I've got Mary. It says, Auntie Esther, I just started a new job and my income is going to be between 45 to
Going up
75,000.
from 45.
It's going up from 45 to 75. I can't contribute to my 401k until I've been there for a year. What should I claim for withholdings? I am single and I rent.
Okay, well, first of all, Mary needs to, it's Mary, right?
Mary.
She needs to put money into an IRA.
Yeah.
Right? So that'll help reduce her taxable income, even though she doesn't have the 401k available.
Yeah.
And as soon as she can get into the 401k, she should do it.
Yeah.
The next thing, $75,000 is a nice little chunk of change for a sweetie pie.
Right.
I think she should look at buying maybe a duplex or a house.
Yep.
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 Because then she'd be paying, instead of paying rent, she's got an asset that she's building up, right?
That's absolutely
So even though there's not going to be the tax benefits, it sounds like in the future that there were in the past, owning the asset of real estate is still good. And if you own the property 2 out of 5 years, the entire gain, if you sell it, is going to be completely tax-free. So that's a great way to save.
And I love what Mary's doing. She's asking the right questions and she's trying to plan. And so I think that is wonderful. Chris?
Yep. And I know we always preach take your money now, don't wait for later. And there are people who love that big refund. I'm going to claim single and zero, so I get this big refund. I mean, you may want to look and that's where you have to. Do you want to just break even? Do you want to owe a little? Do you want a little bit of a refund? So, and that's where we got to play with if you contribute to an IRA or not. So you may want to claim single and 2 and just barely break out even. You may owe $10, but that's okay.
And sorry, I was going to ask her when she started the job, because maybe the preponderance of the years she had the lower income job,
Yep.
you know?
Well, if what the proposed tax laws go into effect, your tax liability next year is going to be about $7,600. So you would just divide that by 12, and that would be the amount that you should have withheld just to break even. So that's a little over $620 a month. And so if you get paid twice a month, $310 a pay would come out. So again, anybody that wonders how much to have withheld, if you want to break even, not get a big refund, just give us a call and we'll be happy to have you fill out corrected W-4 forms, because getting a big refund is not a smart thing to do.
That's right, like Chris said.
All right, what else we got here, you guys?
Courtney writes in, E.G. Tax. My husband just started lawn cutting this year. He brings in about $400 cash a week. I asked him if he's planning on paying any estimates, and he said he isn't planning on claiming the income because it's cash. Do I have to file with him? I don't want to be liable when it, in quotes, hits the fan.
No, nobody has to file a joint. You don't have to file a
Well,
joint return.
unless the new tax law is imposed, and you said married filing separate isn't an option.
Well, no, I didn't. I said that you're considered single.
Okay, yep.
I mean, it looks like they're only talking about two things, single
Yep.
and married,
Yep.
right?
Yep.
So it looks like if you're not filing a joint return, you're going to be considered single for
Yep.
tax purposes,
Yeah,
right?
and so like Esther said, you don't, nobody has to file that way, and so you certainly have an option. What were you going to say, Chris?
Oh, I was listening.
Oh, you were listening.
But you know, here, this is like the typical person who thinks they're getting away with something. So $400 a week, we'll say he works 20 weeks, that's $8,000, right?
Right,
So he had to buy lawnmowers,
right.
right? He probably had to buy a trailer. He has mileage. He has weed whackers he bought. He has his supplies. He has, you know, he could have over $8,000 worth of expenses.
Or more.
Or more, where he would be saving money on his taxes because he would be at a loss. And so he could end up costing you guys money, Courtney, instead of thinking he's protecting the money. He could be costing you money.
Right.
But a
So-
mind is a
So
crazy
not
thing.
only is what he's proposing to do
Illegal.
unethical, illegal, but the truth is that if he really starts building up a really good business, it has asset value. And Chris is saying as you start to buy all those assets, you can write them off up front, so that the money that he thinks that he's going to have to pay taxes, he can do it absolutely legally, and it won't cost him anything or very little at all.
Right, because it's not just the IRS, it's New York State, and New York
And
State sales tax.
He better charge the
So
sales
she's
tax.
doing the right thing. At least she knew,
Right.
I don't want to be held liable, because if you file a joint return, you are just as liable as
they are.
Yep.
Okay, what else we got?
I've got Sammy from Amherst, New York. E.G. Tax. My daughter is going to college next year, and the college told us to fill out the FAFSA form, but she won't qualify for financial aid money. So why do I have to do that? Can I just skip that step? And the truth is, no, you have to fill out the FAFSA even if you don't qualify, because you need that FAFSA to get loans. And so the school really needs you to fill out the FAFSA form. And as of October 1st, you're going to start using the 2016 to fill out your FAFSA form. And if you need any help filling out that form, we're always there for you.
Right, there's no charge. EG Tax doesn't charge. The other thing is the Empire State Credit.
Excelsior.
Excelsior, that's it. That's based on 2016 income as well.
Right,
Right?
right. So, I mean, FAFSA you may not qualify for, but the Excelsior program you may qualify
Right.
for, because that's a higher limit. So you really got to look at all your options. And I know we do have some college experts we are partnerships with. We could give you a phone number for them for you to call and deal with and see what else is out there available.
Yeah, I think you don't want to be like an ostrich and stick your head in the sand. You want to make sure that you know everything that you possibly can. It's so good to ask a question, because you can walk away and say, oh my gosh, I had no idea about that, you know?
Yep.
So You want to make sure you call.
And the sad part is they look at 2 years behind tax return.
I don't understand. I know it's because they don't want to amend all those
FAFSA
financial
forms,
forms, right?
But, looking at it maybe in 2 years from now, if you come in now, we could look and do some tax planning where maybe putting money in your 401k, putting money into an IRA. Are there other tax deferred
strategies.
revenue avenues you could go to bring your income down to
Which
help
does two
assist?
things. It helps you with your financial aid, number one. Number two, it's building up your pension plan,
Yep.
right? And it's saving you tax dollars now. So 3 benefits just by knowing what to do.
Yep.
Okay. And we got a quick one here.
Robin says, Esther, I spent around $2,500 looking for college for my son. Can I use this as part of my college expense to use?
That was a very quick one, Tiff. What's the answer?
No.
No.
Right. I did. Did I do good?
You did real. That was as quick as you could get because the only thing that's deductible under the education credits are
Cost of college
the
and
cost of
related
the
supplies.
education, the cost of the tuition, and the cost of the related supplies.
Right, right.
And so going to visit, while it is lovely and makes you feel so good to walk around those Ivy League schools, it's just not deductible.
Right.
Right.
Yep.
So, all right, I'm Esther Golias, the tax lady from EG Tax. If you need the best tax help and for the right price, I will tell you, you can give EG Tax a call at 632-7886. You can visit us online at egtax.com. Ask the tax lady, and I'll answer your questions right away. We're going to take a short break for the news, and we'll be back on the other side with the rest of your emails. I'm Esther Golias, the tax lady from EG Tax. Thanks for listening. We're here to talk about taxes, us and everybody else. And, of course, we want to help you. And if you have any questions, today we're just doing emails. But next week we'll be back with your live phone-in questions. With this upcoming tax season, we have scheduled our tax show. And, of course, our regular radio show here on WBEN, Saturdays at 3 o'clock. And so if there's anything coming down the pike tax-related, you can get the right answer here on Ask the Tax Lady, Saturdays at 3 o'clock, or our TV show, which I believe is going to be airing 8 o'clock, isn't it, on
WBBZ.
on WBBZ, right?
Yep.
Okay, let's go back to the emails. Chris, what do we have?
Sure. John writes in, Esther, with the proposed tax changes, is there anything I can do with my employer since I won't be able to deduct all my expenses for my outside sales job? I have to pay for everything myself, and writing it off on my taxes helps.
I know, it's very sad. I mean, really, my heart breaks for somebody in John's position. I don't know what they're going to do with that. It seems like it's something that would be litigatable. It seems taking it to tax court just seems absolutely wrong that somebody would have to incur expenses and not be able to deduct them.
Yep.
So whether or not there'll be a way to change this so it's more like a statutory employee who is like an outside salesperson or a real estate salesperson where they're considered an employee, but their expenses are still deductible, even though they're on a W-2. So, or a pastor. So right now, the jury's out until this entire tax thing's all nailed out. There's nothing that I can say except I know that right now there's no place to write it off.
On an account, switch the type of way that they reimburse the person.
Well, but that means that the only thing that they can do is would negotiate with the employer and say, I know you're paying me $100,000 and my expenses are $30,000 and I'm picking up the $30,000. Would you pay me $70,000 and pay for all my expenses?
Right. That's what I was thinking. Right.
Which as an employer may not be a bad idea. I hate to say that to avoid paying taxes, but it does, because that saves them $30,000 worth of Social Security and Medicare.
It does. And
benefits and everything else. So plus then they get the write-off. They still get the write-off of the $100,000 because it's now as an expense.
Which is just part of what's going to happen here as we roll forward here, because there's got to be another way to skin a cat. And so, believe me, we're all going to figure out the best way,
just like you
for
said,
an employee to not get shafted. But right now, the jury's out. So people would have to have that very serious conversation with their employer if they're using their car and their office and home to do work and not being reimbursed by the employer.
Just like you said, somebody who has a second home, they might turn it into a rental. I mean, there's more than one way to skin a cat.
Right, right.
Yep. Very
Okay.
good question.
All right.
Excellent question.
All right, what's next?
I got Mort, who says, "Tax lady, the proposed tax law changes have me concerned because I'm traveling. Salesperson. I pay a lot of out of pocket to earn a living. Last year, I had total itemized deductions of around $17,000. I'm single and my wages are around $40,000. Can I still write off my business expenses?"
Well, that was interesting. Mort has the same problem as the other.
Well, so that must mean it's a common thing out there. It's
Well,
not,
I think
you
it
know,
is.
and it is.
and
you know.
concerned. They're concerned.
It's really interesting. They say only a third of the people itemize, which is true. Mm-hmm. But I wouldn't want to be in the third that's losing my itemized deductions, because if it was $20,000 in itemized deductions that they had last year for business, and they're in the 15% bracket, that's $3,000 on the federal and maybe $1,200 on the state, which is $4,200 in additional taxes they have to pay because it's not a write-off. That's a big thing.
That's
It's
huge.
almost $400 a month.
That's
I mean, you got to look. I mean, people don't. You got to look at the whole picture. You
Right.
gotta-
So Mort's got to go talk to his employer. And again, as soon as this thing is all ironed out, we will certainly let everybody know. But right now we're speculating. It doesn't hurt to make some phone calls.
yeah.
And
To
when
your
they say, but
congressman.
we're doubling the standard deduction, tell them, and you're taking away the personal exemption. And you're taking away employee business expenses and medical expenses and New York State withholding and New York State sales taxes and a lot of the home mortgage deduction and casualty losses and employee business expenses and education expenses and gambling expenses. That's what you're taking away.
I wish we had a camera in here and we could record you saying that, because if people could just see your face.
I've got Al from Cheektowaga. Dear Esther and team, last year I paid my son's student loans, and so I was wondering if I could deduct his student loan interest because it would help me on my return, but not on my son's return.
Okay. Who wants to deal with that one?
Well, Al. If your name was on the loan, if you are liable, then yes, you would get to take the student loan interest as a deduction. That's the only way. You know, if you were nice and you said, "I'm just paying your loans off, kitty, little Bobby," there's nothing we can do. There's nothing on your tax return that you can do. So it has to be your name. You are responsible for the loan.
But if the parent is paying off the student loan for the child and the child's name's on there and they both are on there, the child can take it because it's considered a gift for the
Right,
the
but
court
but he's
ruling.
saying the son
I know,
is,
but
yeah,
I'm just giving
yeah.
the flip.
Yep,
Yeah.
yep.
The flip.
And
I'm
you
giving the
you
flip
can
side of
gift
it.
up to $14,000 a year. per
15,000
Now
this
it's
year.
gone up to 15.
Yeah.
Yep, per year.
And of
per
course,
sis-
the if the right now the estate exclusion is on the first $5 million. They're projecting on the new bill, if this goes through, it'll be up to $10 million with a 6-year phase in. So there are no estate taxes. You know, it was interesting. I was talking to somebody who interviewed me, one of the news anchors, and they said, "And I understand AMT is gone." And I said, "Yeah, that's because the itemized deductions are gone. That's why AMT is gone." You know. All right, let's go back
And
to
the personal
they can
exemptions.
spin
Yeah.
it any way you want.
and the personal exemption. Yeah, I mean, here's the thing. When they're saying, and we're doubling the standard deduction, then you say, but you're taking away the personal exemptions. So you're giving me an extra $12,000, and we're a family of 5, and our personal exemptions are $20,750. That's gone. So you're giving me an extra 12, but taking away $20,750. So that's a net loss of $8,750. So $250. Okay, let's go back to the phone. I mean, not to the phones, to the email.
Emails. Anna writes in, EG Tax Team. Unfortunately, I'm in the middle of divorce. We have 2 kids under the age of 17. I believe the kids will live with me and see their dads for visits. I make under $39,000 a year. Is there anything that I should be cautious of in the midst of the divorce? Also, he pays for the child care for my youngest, and he was wondering if he can deduct that on his taxes?
Okay, well, first of all, it's a child care credit, and now here's the thing. It's going to be interesting because it used to be if they were dependents, right? Mm-hmm. So I don't know what they're going to be doing now relative if this change in tax law goes through, since there really is no dependent exemption. But obviously there has to be a place on the tax return to say
To
what a
list who
dependent
lives,
is.
yeah.
That is
right?
very interesting.
Oh, I've thought about this. I lay awake at night thinking of this stuff.
You're just a tax nerd.
I love it. But anyway, so the way it's right now, in order for Dad to take the daycare credit, he'd have to claim the child on his
Yep.
tax return,
right.
right?
You'd have to.
But since they aren't going to have exemptions, I don't know how they're going to handle this on their postcard.
Right.
Wink, nod.
Uh-huh.
So, it'll be interesting. But no, right now he could never take the daycare credit. And since you're at $39,000 with the kids that live in the home with you, you would have this year you'll be head of the household. Next year it looks like you'll revert to single.
Yeah.
So and you won't get the personal exemptions.
And make sure while you're in the midst of the divorce, as you say, that you get everything ironed out and spelled out
But
correctly.
she needs the earned income credit, right?
Yep.
And it sounds like she's working.
Yep.
Yes.
Yeah,
It
she
says
said
she
she
makes
makes
$39,000.
It
39,000.
doesn't say if it's alimony or not.
Right.
Right. But
so
make
if
sure
she's working, she would get an earned income credit, and the daycare credit would go to who?
Nobody.
Whoever the person who paid for it doesn't get to claim the kids, so he doesn't get
So
the
it
credit.
may be better off for her to get the income and pay the daycare.
Well, I was just going to say, it sounds like pretty amicable if she's emailing for him, too. Maybe he just gives her the money and she pays out of a check, not
Right.
cash, out of a check to the daycare facility.
and then she'd get it.
Then she could at least give him the money back
Right,
through her tax return.
right.
Wow. But the personal exemption thing is
It's true. I mean, you have to deal. I don't care what they're talking. They're making the simplification sound like it's so great. Well, just tell them to send you all your money to the federal government. They'll send you back what they feel like. I mean, that's simple too. But really, some of these changes in the tax law are really going to affect just normal people in a not good way.
Yeah,
All right,
the
let us
household.
go back to our emails. What do we got?
My father just passed away, and I was informed that I was a beneficiary on his IRA. Do I have to take all of my money now? Can I roll it over to my IRA? John.
All right. Well, if he's a beneficiary, then he can either
take
take
it all.
the whole thing. He can
Spread
do
it
it, annuitize it based upon life expectancy, or take it over a 5-year period,
Right.
Three
depending upon
options.
what he decides.
Right, he
but
can't-
again, he has to kind of put a pencil to it to see which is the option.
Right,
that
to
he
see
fits
how
in
much
his
is in there
lifestyle.
first, which could determine. But you cannot put it in your own IRA.
Right.
It has to stay in a beneficial IRA.
Right.
And minimum distributions start at your age, not their age.
But I
Right.
can't tell you how many times people come in and make an appointment and sit with us and run the numbers and see which way it's better to take it all 5 years or
It's
annuitize
anything
it.
in taxes. You got to run the numbers no matter what, because until you run the numbers, you really can't. It's just like listening to the rhetoric on TV. People say, and they're doubling the standard deduction, but they're taking away the personal exemption. So until you look at those numbers, but we're giving a $1,600 credit instead of $1,000. That's true. That stops when children are the age of 17. But how about your other children? You get nothing for them. And then who's going to determine what a qualified non-child dependent is? How does anybody determine?
Right,
that?
how are they going to determine earned income credit?
Who wrote this?
How
I
are
don't
they
know.
gonna-
Well, we'll see.
Proposal.
We'll see. Somebody's got to write the law.
Close the loops.
Right. I'm Esther Gullius, the tax lady from EG Tax. We're not answering your live phone-in questions this week. We're doing emails, so we're going to take a short break, and we'll be back with your emails on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax. We have about 12 minutes left in the show, and during the week, if you have any questions, whether it be healthcare related, tax related, you're wondering if this tax law goes through, how it's going to affect your tax return, just give us a call, give us your figures over the phone, and we'll tell you how much more or how much less you're going to pay in taxes, I think you're going to be surprised that most people are going to be paying about the same or a little more. Not too many are going to be paying less. And we're very happy to help you. Our phone number at the office is 632-7886. Okay, let's go back to our emails.
Unless you're a corporation, and then you might pay less.
Oh,
right?
which reminds me, if this thing goes through, let's say, for instance, that you have a C corporation, right? That's what they would call a big corporation, although many C corporations should be S corporation, but we won't go into that. And you're taking a salary of $500,000 off your C corporation. And you're doing that because it's double taxation, right? If this law passes and they reduce the C Corp to 20% maximum, that may mean that you would be better off reducing your salary to $100,000, letting the $400,000 stay in the C corporation, because that would only be taxed at 20%, which would be $80,000, instead of it being taxed at the 39.6% at your tax bracket, which would be twice as much, right?
You're
Yep.
good
And
at
have it
saving
pass
money.
through as a dividend.
Yep. Boy, you really got to ask the right questions and plan.
You really do, and that's why tax planning is so important. All right, let's go. Yes.
I got Larry. EG Tax. My girlfriend and her 2 children moved in with me in April. Someone told me since I support the children, I should change my withholding at work because my refund will be like Christmas for me. Sounds too good to be true.
It is.
Smart man.
It's too good to be true.
Yep. If
Because-
they're not your biological kids, they're not. Or
Now,
you
if
didn't
he
adopt
marries
them.
the girl,
Right.
married the girl, Larry, and then they would become your stepchildren.
Right.
If they are your stepchildren,
It's greater
then,
than
and you file a joint return with their mommy, then you'd get the and they're under age 17, you get the $1,600 or $1,000 child tax credit, and possibly an earned income credit. But if you ain't married to mama, then those are not your children, and they're not your stepchildren, and so basically you may claim them as a dependent, but they won't make any difference,
Well,
right?
you
Because they're
can't.
not your children.
You can't claim them unless they've been in your house
for the full year.
Full year.
For a year.
Under the
So there would
present
be
tax law.
nothing. If you change your withholding, you're in trouble when it comes
You'd
to
be
tax
very
time.
sad, Larry. But
Yeah.
You'll
you know,
get the lump of coal
Now,
instead.
Now the truth is, the girlfriend. I'm hoping that she's working, or you should tell her to go work.
go tell her to get a job.
Go tell
because
her to
she'd
get a
the earned
job.
income credit.
Yes, so that's something that you'd want to look at because she's got the 2 kids, and so hopefully
So
she'd
when you get
file
home
a
tonight
return.
after listening to the radio show, say, "All right, Ethel, you got to go get a job because either I don't get any tax benefit, or you
Right.
got to go get a job so you get the earned income
And when
credit."
she files, she would probably file single with her 2 kids.
She'd have to.
Yeah,
She's not
yeah.
going to be head of the household.
Right.
You know,
under the
and
current
again,
law.
we don't want to mix up this year's tax law with the proposed tax law.
Right,
right.
right.
But I'm already in that kind of a mode, thinking like that.
Not you,
Right?
not
Yep.
you. But getting married sounds like a really good idea for them.
All right. Anything else? Yes, sir.
Okay. Ryan writes in, I had to move in with my mother to help her out 5 years ago. Before she passed away, she turned her house into my name. I want to move to Florida and enjoy my retirement. Should I sell it? What will it cost me in taxes? Or should I just be a snowbird and not pay any taxes at all?
Uh-oh. It sounds like it was a gift and he didn't inherit it, because it sounds like before she passed away, she signed it over to him.
Did she inherit it, or was it
It-
gifted?
it
to her?
says
Can you
before she
touch?
passed
Before
away,
she
she
passed
turned it
away,
over.
she turned the house into my name.
Okay, so it was gifted.
Yep.
Yep.
So that means that the mother's basis is her basis.
Yep.
So
Right.
instead of getting the stepped up basis, he reverts back to her original cost
Right.
plus all the
Right.
improvements.
So if he sells it, depends upon. But let's just real simple math. Let's say it sells for $100,000 and the cost is $20,000. So it'd be an $80,000 gain, depending upon what tax bracket he's in. Right. Yes. Mm-hmm. Go.
Okay. How long has he lived there?
If he's been living there for the last 5 years, it's going to be tax
That's
free.
what he said. He's been living there for
Oh.
the last 5
Then
years.
he's good to go. He can sell it.
So
Like-
he has no problem with taxes as long as the gain's not over $250,000.
right.
So
So, but he could keep it. I mean,
He-
there's no reason why he wouldn't be able to keep it. And if it's his primary resident, let's say he goes to Florida for 5 months out of the year and comes back to New York, the other 7 months, if it remains his primary residence, that
That's the
exclusion is
key
going to be
right there.
I think you should break down everything that we just said right there. So, right, because you always say that, break it down. And so
Oh, yeah.
So what you chew it up, what you just said there is if you are gifted a house, usually you have to go back to the original basis.
Which you do.
And right, if you inherit a house, then you get the stepped up basis.
right. But in
now,
this
if you
case, he lived in the house that
for the
was
last
gifted to
2
him.
out of the last 5 years. So then that's a different caveat law, and that is, Chris.
That if you live in the home as your personal residence for 2 out of the last 5 years, then the gain up to $250,000, 500 married joint, is tax free.
Right.
Right.
So
it gives him a lot of options.
It
Right.
does. It does. I mean, there's so many things, and it, like you said, if he wants to be a snowbird, keep the house up here as his primary, because then that will be tax free when he sells it. And eventually, if he does move to Florida full time, sell it then, and then live in that Florida house for 2 out of 5 years, and then you could sell that one.
Right. And you know, speaking of houses, even though with the proposed tax law changes, there isn't such a great tax benefit for owning a house. This is a great benefit. If you live in your personal residence 2 out of the last 5 years, the gain is completely tax free. If it's under $250,000 and you're single and $500,000 married filing a joint return, that's a remarkable thing on your primary residence. Many people buy and sell houses every 2 years and take advantage of that exclusion
I don't
because
know
it's
anybody.
remarkable.
I was just
I don't
thinking
know
that.
anybody who does that.
Me neither. I do.
I think
love
it's
to
your
move
passion.
anyway.
It's your passion. You
I love to move anyway,
Yeah.
and I love to decorate.
Yep.
So
yep.
I usually buy a house that has some problems, and
Fix
live in
it
it
up.
and fix it up,
Fix her
and
up.
then around a year and a half into it, I start thinking, gee, maybe I can sell this.
How much could I sell this for now?
Yeah, and then you
Is
get
it-
you get to exclude the gain, and it's a wonderful way to build up an asset value. Can you imagine? I can't think of very many investments. I can't think of any other investment that says the first $250,000 is tax free, and you can just do it over and over and over again if it's your personal residence.
I just thought of something with tax law, the proposed changes, and I know what the house up here, your husband's house went through up here with the Lake Ontario flooding, the casualty that happened. Well, new tax law changes is those casualty losses
Are not deductible.
aren't deductible. So if you are in an area in Houston, in Florida,
St. Louisiana.
Louisiana, in
San
Lake
Juan, Puerto
Ontario,
Rico.
Puerto Rico. Get those casualty losses in now. You may have to pay someone $250, $300 for
an
a
appraisal.
pre-appraisal, but get it done now because next year
If
they
it
could
goes
be gone.
through, there won't be any casualty
Right,
loss.
and they're saying they want to try to push it to predate it back to the beginning of 17. So these people would have to amend their 16's
amend their
return
returns.
to do it.
Take any deductions.
Yeah.
That's
Yeah.
correct, because at least they're but in order to do that, it has to be federally declared
They're
disaster
disaster
area.
area,
That's
Right.
which most of those have.
And if you don't know what we're talking about, you can call us and say, what were you talking about? Because we're happy to help you. But the
Understand
important
it.
thing is, ignorance is not a good thing. You want to ask questions. Don't assume, many times people will say to me, oh, I can do it myself because it's easy. Hey, I want to tell you something. It's only easy because you do it yourself. I mean, isn't that true?
Yeah.
Sometimes people will say, well, there's nothing, all I have, I'm 62, I'm working part-time at Walmart, make $8,000 a year in my little bit of Social Security, married filing a joint return.
If
There's
they're
nothing
under-
I can do.
if they're under the
Wrong.
age of
You get an earned
65,
income
yep,
credit.
yep,
right?
yep.
You get it, and so it's easy when you do it because you just did it wrong.
Yep.
And you just cost yourself some money and you shot yourself in the foot.
Do you know, I had someone come in, I did 3 years worth of returns. I said, why are you doing it now? And he goes, well, because I'm going for a job and I have to. They won't hire me unless I get these done. He goes, I know I'm not getting anything back, but I just want them prepared. So I'm doing the return, and I said, well, do you have unemployment for 2014? Oh, yeah, I do. Well, still was under the minimum, but he had federal withholding and state withholding that he was about to lose. But he was also on the subsidy for health insurance. Well, his income was so low, he got about a $2,500 refund,
tax credit.
Premium tax credit.
back for 14.
Wow.
For 15, he got a $3,000 refund, but he wasn't going to file because it was going to be at zero.
See, because it's so easy. It's so easy. I
Ignorance.
can do it myself.
Yep.
And believe me, if you don't have any income, you'd be surprised. They want to pay you.
Right.
Because remember, much of our tax law in the past has been to subsidize low-income people through the tax code. Now, this may be changing with our new president, but that's the way it was. And so as long as that law is in effect, you want to make sure that before you say, I'm going to close the lid on this baby, you make sure that there's nothing that you can do to help yourself on your taxes. But in the meantime, EG Tax is here to help you. You can go to us and visit us on our website at egtax.com. Our phone number at the office is 632-7886. I hope you have a wonderful week. We're looking at the holiday season. I hope if you need any help getting extra money for Christmas, I want to tell you something. Changing your W-4 at work is a great idea, so you get extra Christmas money. Until next week, I'm Esther Golias, Christopher Fabian, Tiffany Fabian. Have a blessed week. Thanks for listening. Bye-bye.